Welcome back, Keith Hobart from Peak Mortgage. Excited to have you here to talk about home equity and using it responsibly.
Yeah, thanks for having me again.
Yeah, so let's jump in. What is home equity for those who have never bought a home and don't really understand it? And then how does one calculate how much equity they have in it?
Yeah, no, pretty straightforward. So the equity in your house is basically just the difference between what you owe on it and what it's worth. Yeah, if your house is worth $1 million and you have $500,000 on it, your equity in the house is roughly about $500,000.
Yeah, and so calculating it, there's a couple different things you have to take into consideration there. One is if your home is appreciating, because the value, that's the first part, can change over time, or depreciating, I suppose, in a worse market. I know for my clients, I help them track their home values monthly as well as manually do it every year. So that's one way. And then I guess the other factor in that is what they owe on it. How do they, what's the best way to find out what their balance is?
Yeah, generally just whoever their loan servicer is through, it'll show that on your most recent mortgage statement, or you can log online and it'll say what your outstanding balance is.
Perfect.
So just keep in mind if you had any kind of weird seconds or anything like that when you purchase it, it may not be on there, but that's for the most part, that's going to be enough to get.
Yeah, and that would, a good scenario with that, with the seconds on there that you might forget would be like
one of the down payment assistance loans, something like that.
You're not getting a regular bill on some of those. So
exactly.
They
can
out there
can be forgotten pretty easily.
And what are the benefits of pulling cash out through a HELOC, home equity line of credit, or just a regular home equity loan? Why would somebody do it? What?
Yeah, I mean, kind of the options are endless as to why, right? There's definitely there's definitely a lot of things that could be from home improvement to debt consolidation. To maybe wanting to purchase another home. I mean, the kind of the possibilities are endless there, but those are the big ones that we see: home improvements, debt consolidations, or future investments.
It makes sense. And I think the home improvement is probably of all the options going to give you the best return on that money.
Exactly.
You're also going to increase the value, at least in theory, increase the value of your home if you're doing home improvements, where that Tahiti vacation isn't exactly going to bring additional equity to you.
Exactly.
And then, how does a cash out refinance differ from home equity loan or home equity line of credit? I guess, what are the different products in there? Because there are a few different ones for different scenarios.
Yep. So home equity line of credit or a home equity loan, they're very similar. One is just like it sounds, is a line of credit. So kind of consider it like an open bank account on your house that you can tap into and pay off as you choose. The other home equity loan is you're just getting a loan for X amount of dollars, and as soon as you're done, the bank's giving that to you. And then a cash out refinance is you're actually refinancing the whole thing. The first two that I talked about, you'll actually have it's called a second loan in place. Mm-hmm. They're in second position. And so you're making payments. You're making two payments, one to your first mortgager, and then the second one on top of that. A cash out refinance is you're actually refinancing your entire mortgage, so your entire first, pulling out equity from there, and then you're only going to have one mortgage payment to make every month.
Payment.
Yeah.
What if someone's considering those? Is there an advantage to doing a cash out refi? Is it better rates on those than HELOCs, or is it just dependent?
Yeah, so I mean, HELOC and home equity loan, the rates on those are generally higher, but also your loan amounts can be a lot less, right? So if your first mortgage is $500,000 and you want to tap into $100,000 with equity, you're gonna maintain that $500,000 one at whatever your current rate is, and then
if you bought, say, 2 years ago or 3 years ago and you have a 3% rate, that might make more sense.
You want to keep
that.
Yeah, generally you'll be keeping that. Yeah. And two, that just depends on the loan amount. I mean, there's so many different scenarios that we could kind of talk through and probably spend 30 minutes on this one, but there's just so many different scenarios in terms of maybe you just need a very small amount, maybe you need a large amount, and what makes the most sense for you. Talk to a mortgage expert and get that advice. So
one question I have, I'll throw you for a loop because I didn't include it up front here, but I remember a couple of years ago, Wells Fargo, they had a bunch of HELOCs out there. And so like the difference between a line of credit and a loan is, one, you get, like you said, you get the lump sum. One is like a equity you can tap over time. But I remember Wells Fargo, when they were kind of getting out of HELOCs, if you had like a $400,000 line of credit, but you only took $100,000 out, they just
turn it off. Yep.
Is that like a typical risk, or was that like a really odd scenario? Is there any situations where you see that being a risk? obviously, I think if the economy, tanks, there's probably more risk for it. Any advice on that or thoughts on that?
I mean, some of those things are just impossible to predict, right? It's all about that current company's appetite for what do they want? What are they seeing in the future? I mean, they saw something they didn't like there and they were worried about possible depreciation and they just put in carpet changes across the board. So even though your market may not be in a depreciating market, they don't care. It's just all about risk management for them. So yeah, some of those things it's hard. You never know. We saw a lot of those back in 2008 too, right? A lot of people had HELOCs in place, and they had it in place as kind of their emergency fund, and then all of a sudden that emergency fund got turned off, and there's nothing they could do. So,
right. And right now the economy is, knock on wood, fairly stable. Probably lower risk of that happening, but I guess maybe a question for you is, in a less stable environment where that might happen, would there be a time you would tell somebody like, hey, just take out the full loan so that you've got the cash up front? Or is that a really big thing to try to advise somebody to do?
Because you're paying interest on that, right? I mean, all of a sudden, yeah, you tapped in that $100,000 that you had sitting there in case of an emergency or whatever, and now you're paying interest on that. So that's a hard thing to do, especially
pretty rare scenario to tell somebody to just go for it.
Yeah, exactly.
And what are the risks for borrowing against the equity, with the HELOC or refinance? What risks are there? Any risks, I guess, and then what are those?
Yeah, I mean your mortgage payment's going to go up, right? You got to be making payments on that every month, and a lot of the HELOCs are interest only too. So keep in mind on that you're only required to pay just the interest on those HELOC products. You can
principal's never going down.
Yep,
you're making payments.
Exactly. So you can be stroking a check every month for a couple grand, and that's all you're doing is paying the interest. So
paying the bank.
Yeah.
What impact does doing a cash out refinance or HELOC, I guess we kind of talked about this, have on your monthly mortgage payments? We talked about that already, I guess, just in the difference. And now, you also mentioned the interest only payments. Is there anything else that might have an effect? Mortgage insurance on a regular loan over 80% loan to value. Is there any of that in a cash out refi or HELOC, or do they not even let you go to over an 80% loan to value?
Yeah, on a cash out refinance, we're typically capped at 80%. So kind of the general rule. If you're doing a HELOC or line of credit, a lot of times you can go a little bit higher than that. You might be able to go to 90%. Is typically about most of the places where they cap that on that. So yeah, it just depends on the product that you get into and how much money you're tapping into. But yeah, you're gonna be paying more per month. So
yeah. And there's no, if you did find one that was 90%, there's no mortgage insurance on.
Correct. Yeah, not on.
They're just taking the risk on. Probably just higher rates, I imagine.
Exactly. Yep.
Makes sense. And then again, kind of leading into the next question, the eligibility requirements for the cash out refi or HELOC. We talked about equity. Any other requirements that pop out?
It's kind of the same qualification. So at the end of the day, it's debt to income, and we got to make sure you can pay back that additional debt every month. So you're going to go through the same strict standards that you got your first mortgage in on the second one too. There is some streamlined HELOCs out there, and we do a few of them where it goes pretty quick, and we don't necessarily have to jump through all the verification hoops and the appraisal hoops and things like that. But it depends on how much you're trying to push the envelope as well.
Yeah, I guess bringing back the debt to income question with the HELOCs where it's interest only, what is the debt to income calculation? Is it only on the interest, or is it if you were to make a full mortgage payment? How do they calculate the debt to income?
Yeah, there's maximum payments calcs that we get on that.
Okay.
And we kind of we go worst case scenario on that when hitting you when including that in your debt to income ratio. So
that makes sense. And then what are any tips or strategies for just making sure you're not over leveraging your home by borrowing too much? And I guess that's more or less mortgage rules and just advice. What do you, when you're talking to your clients, what do you talk to them about? Just making sure they're not pushing themselves too far.
Yeah. I'm just really just giving them all that information. At the end of the day, it's their decision. And I've had to put people in loans I didn't necessarily think was in their best decision, but at the end of the day, I have to do that. Right. So I'm legally required to do that. So no, it's just education. Just give them as much education as possible out there, helping them make the best decision and making sure they're aware of all the consequences, both intended and unintended consequences of getting that particular loan program. So
yeah, that makes sense. Cool. Well, that's all we've got for this one. Look forward to having you back another day for some more videos.
Awesome. Thanks, Joe.
Yeah. Thanks, Keith.